Okay, well, let's just discuss a bit more on the markets. Let's bring on board Nilesh Shetty, the Associate Fund Manager for Equities with Quantum AMC. Thanks so much, Nilesh, for joining in. Good afternoon. It's been quite a few exciting days that we have seen, whether it comes to the markets, and of course that in turn is perhaps to a certain extent moving based on what's happening across the border. To what extent are geopolitical tensions at this point of time, whether it's with respect to India, Pakistan or otherwise, playing their role when it comes to our own Indian equity markets?
Yeah, they do impact sort of near-term sentiment, but essentially these are outlier events. When you're trying to value businesses or trying to value companies, you really don't factor these scenarios. You're trying to assume business as normal and then trying to find out whether these companies offer value. If they were to play out and escalate, then you should expect correction and perhaps a deeper correction, given that FIIs, who still hold a large chunk of the Indian markets, perhaps they might want to reduce risk. But by and large, it's very tough to factor into your valuations. And what you do is you just assume business as normal and try and find companies that offer value in that scenario.
Hi, this is Nayantara joining in from the New Delhi studio. You've got a lot of uncertainty on at the moment, but it's still election year. I think the big theme that every fund manager has been talking about here for the last 6 to 9 months has been consumption. My question to you is, isn't that story now getting very expensive, overvalued? And would you agree with that? Or because of election year and the consumption being one of the biggest beneficiaries, there's still some upside left? Now, for example, look at Kishore Biani. He's managed to ink one more deal with Japanese giant 7-Eleven, something the markets never imagined maybe, let's say, 3-4 months ago.
Yeah, so again, within the consumption basket, there are two kinds of plays. One is the sort of the consumer staple and slash retail space, which has always been very, very expensive in terms of valuations, and they never corrected even sort of when the market started correcting post-September. The other bucket is the consumer discretionary space, which is auto companies, your media companies, your hotel companies. They've sort of seen a meaningful correction. And there we see significant value. So if you look at a fund right now, we have the largest allocation to that space because that is where we see valuation comfort right now. And our sense is, as sort of last 3 years, one of the big problems has been sort of depression in rural India, which has dragged down sales. As sort of the economic cycle turns and as you see sort of more money being spent in rural India, these companies should benefit. And given where valuations are in that bucket, perhaps that is where you will make your long-term returns.
All right, Nilesh, let's just put it down to individual sectors and movers and shakers. And I must start by talking about the auto space. I mean, we do have the numbers coming out tomorrow, but the jitters are already seen. Today in the equity markets, it's one of the worst performing sectors. The last 4 to 5 odd months have really seen sales dwindle down month on month, year on year. What can we watch out for come tomorrow?
I did not get the name of the company. Which company are you referring to?
Actually, I was talking about the auto names in general, because tomorrow we do have the auto sale numbers, and month after month we've just seen the volumes dwindle. Today, in fact, in anticipation of the numbers, the stock prices are all down. So what should we watch out for tomorrow?
Yeah, the near-term numbers, especially after October, suddenly have sort of dipped. And we are just trying to figure out whether it's the impact of what happened post IL&FS and whether financing of these vehicles have slowed down. But again, we sort of build a portfolio 3 to 5 year. Even if you assume sort of slightly slower near-term numbers and you normalize for long-term growth in that space, given where penetration is in India, and you look at the valuations compared to that, they offer significant value. Most of them are trading at close to the lower range of their price to earnings ratios. So again, our sense is this is a better time to buy into these companies, assuming whenever the cycle normalizes, they will get back to their long-term median valuations. And that is sort of the story that we are playing at. So, again, near-term numbers could be depressed given what has happened on the financing side of this business.
Okay, Nilesh, the other part and the other sector rather that I want to talk about is what's happening with the technology space. You know, I mean, I think the last few months we've seen a lot of movement in the technology space as well, and many are saying that perhaps even 2019 will be the year for technology. What would you make? And especially, you know, there's a very marked difference between mid-cap technology and the bigger names like a TCS and an Infosys, etc. So, how should investors really play this part of the market?
Yeah, so technology, I mean, if you were to look at these stocks 2 years ago, it looked like these businesses were going to go bust. The kind of valuations that they were quoting at, a lot of them were sort of over 3% dividend yield. So the time to buy into these stocks was then, where the business itself was going through transition as the share of digital was increasing. But because of that transition, growth rates were suppressed and the markets were very skeptical of these companies' capabilities to be able to manage that transition. But since then, of course, growth rates have picked up for this sector, and a lot of the pessimism around these companies have disappeared. Now, of course, they also offer a hedge against the rupee. Given the geopolitical tensions, perhaps there is a negative view on the rupee as well near term, and these companies tend to offer a direct hedge against that in your portfolio. But the valuations are no longer cheap, even though there is some upside left. But perhaps buying into this sector right now is not the best of ideas. There has always been a big gap between quality of the larger companies and the mid-cap companies. So the mid-cap companies had a strong rally in the entire mid-cap, small-cap rally that we saw over the last sort of 3 years, from 2014 to 2017. But as that space corrected, even the sort of the mid-tier companies have also corrected with that, apart from sort of specific names. But our sort of bias has always been toward larger cap names, purely because the difference of quality, given that scale plays a huge role when you go and bid for tender or contracts in this space.
Leave it at that. Always a pleasure chatting with you.